All right, good afternoon, everyone. Welcome to today's webinar where we will be covering all things related to long-term care insurance. Our guest today is Bob Gertie, somebody I've known for the last 10 years, and he is the guy that we go to whenever we have any questions about long-term care insurance, life insurance, long-term care in general. He's a great person in this industry, and he's been helping us for a long time. We have a lot of stuff we're going to cover today about the state of long-term care insurance, how coverage is working, what the premiums are, cost of care, how it integrates with Medicare and Medicaid, what happens when you need long-term care coverage, what are the costs, what at different types of facilities. He's also going to talk about continuing care retirement communities, otherwise known as CCRCs. And he has a couple case studies at the end that will talk about like, should you get, what age should you get coverage at, and what happens when you wait till later ages. And then at the end, he's also going to talk about for people that have long-term care insurance now, how in-force policy rating premium increases are affecting the industry currently. We have a lot to get through and only about an hour or so to do that. But if we need to go long, we have the option of doing that. If you have to jump off, it's going to be recorded, and we'll be sending a link out to everyone with the link to our website where the recording will be posted. As always, if you have questions, I will be moderating those, but you can drop them in the chat or question box as they come up. If I know that it's going to be covered later on, we'll wait, but if it's relevant to the slide that Bob's talking about, I'll interrupt him and ask the question. Without further ado, Bob, you take it away. Looking forward to hearing what you have to talk about today. And thank you for
Sure.
joining us.
Absolutely. Thank you for having me. Certainly a pleasure to be with you and with your staff and with your clients. Just to give you a little bit more information on who I am, I'm an independent insurance broker. I'm licensed in 48 states. We currently have a book of business of about 6,000 clients. The majority of people that we work with are high net worth, high income individuals. My practice is 100% referral, and we've been featured in publications such as Forbes, Financial Advisor Magazine, NAPFA, Money, and so forth. I'm a NAPFA resource partner and consistently do a number of different educational opportunities, whether they're through financial planning associations or direct with firm presentations. Today, we do have a fairly robust agenda. We're going to talk a little bit about long-term care, what actually long-term care is, who needs it, where does this take place, and what does it cost. Then from there, we're going to take a dive through a planning scenario of a 60-year-old male and female couple, understanding every option that they have when it comes to dealing with long-term care services and how they would fund those through federal programs, using their own money and self-funding, those CCRC type facilities, and also with long-term care insurance. We'll talk in that long-term care insurance side about traditional long-term care insurance contracts, as well as hybrid or combo type plans and group or even worksite type plans. From there, we're going to talk a little bit about the application process, what to expect if you do need to implement coverage, and then also those rate increases that we typically see within existing contracts, what we should expect on a new policy purchased, and what we should expect potentially on a contract that's already in force. I will leave a little bit of time for questions. As Jonathan had mentioned, I do have some capacity in my schedule. If we do go in extended questions, more than happy to help. So let's talk about what long-term care is. Okay, this isn't really the insurance aspect, it's just understanding what long-term care is. And this is a range of services and supports for personal care needs due to aging, chronic illness, or disability. This is typically going to cover two things. The first of which is activities of daily living, commonly known as ADLs. Now, HIPAA mandated that there are six of these. Okay, so before this, there were some that were eight, some that were four. Right now, everything is six, which are bathing, dressing, eating, transferring, toileting, and maintaining continence. Long-term care also talks about the services that we would need for our health or safety due to a cognitive impairment. This may be preventing us from wandering, remembering medication, those types of things. There are also some things known as instrumental activities of daily living, or IADLs. These are tasks that are secondary to our common daily living activities, but this may be something like meal preparation, some housework, maintaining our finances, shopping, transportation, and so forth. Now, the people that need long-term care, right now they're giving us statistics that show about 70% of people that turn age 65 will need some form of long-term care in their life. I don't like this statistic, and I tell you why is because for an individual that has a stroke while they're in the hospital, they need help taking a bath and using the restroom, that person falls within this guidance. So I like to look a little bit more about how many people are actually filing claims in using long-term care services and support. Right now, we're seeing that number right about 56%. So truly, anyone that reaches age 65 has just over a 50% chance that they're going to need support with these types of services. Now, we do find that women are more likely to need long-term care than men. Typically, we're seeing about 75% of women over the age of 65 require long-term care services, where that number is more like 64%. When it comes to claim statistics, right now, women account for two-thirds of long-term care claims. And the women we find typically average about 3.7 years in terms of claim duration. For men, that's 2.2. This is also a number I do not like. And I'll tell you why is because most of this data comes from Medicaid or the insurance industry. The problem with the insurance industry, they're only going to release data that supports their product. Okay. So they're going to talk about the largest claims that they've paid and so forth. And then we also find on the Medicaid side, it's only going to be skilled nursing care. So I do offer some caution in some of these data points that we're discussing. Now, the common conditions that we find associated with people needing long-term care, Alzheimer's, dementia, stroke, heart disease, arthritis, diabetes, and Parkinson's. Those are the leading claims that we're starting to see. Right now, we're seeing over about 25% of age 85 plus need help with at least one activity of daily living. Nearly 20% of those 65 plus will need care for at least 5 years. And 40% of adults over the age of 85 currently have severe needs, compared to just 8% in that 65 to 74 range. This is truly care that we're seeing more and more people, the older that they are, need this care. And a lot of the medical advances that we have are doing things like prolonging how long Parkinson's patients live. So a lot of times we're seeing medical things that actually extend some of this data. But this is not just for seniors. We're seeing right now about 40% of people are in the working age between 18 and 64. This is also a data point I'm not real excited about because this does account for somebody that was in a car accident. They're in the hospital, they come home for recovery for a period of 6 months. During that time, they're using those support services. They're also going to be included within that statistic. Now, it's important for us to know where long-term care takes place. Where are these services going on? We've got home care. This is actually the most preferred setting that we see. And right now, people that are actually receiving paid service after the age of 65, it's about 29%. So about a third of people are receiving care within their home. Assisted living facilities. These are places that do not provide 24-hour round-the-clock hands-on assistance, but every time that we need help getting out of a chair, every time we need help taking a bath, they're always going to be able to provide those. Right now, we're seeing just under 1 million people in the US are currently receiving assisted living services. And then there's skilled nursing facilities, which are more commonly known as nursing homes. This is truly 24 hours a day, 7 days a week care and supervision. This is by far the largest place that we're seeing people currently use care. Right now, it's just under 4 million Americans. Now we find the median price across the country for a semi-private room, meaning you plus one other individual, is right at about $9,500 a month. And we're seeing about a third of people are using at least 90 days of nursing home care. Only about 15% are in nursing homes for more than 2 years. Medicaid is by far the largest payer of nursing home care. We've got private pay insurance. Medicaid is primary, the number one payer of skilled nursing facilities. We also have care that can be provided in adult daycare centers. This is something that typically is utilized when a family member is providing care, but maybe they also have to work during the day. So typically in about $100 a day range, they can take their person that they're caring for to an adult daycare facility. They will then provide those services to them throughout the day. Then they get picked up, and then that caregiver can continue providing that at home. Another opportunity is continuing care retirement communities. These are really campus style type communities. They typically offer independent living. And then if that person has a need for care services, they can either provide that within their home that they're living in the community, or they can transition them to an assisted living facility, nursing care, and oftentimes even memory care as well. Oftentimes, these people are transitioned through these as their care needs increase. Unpaid caregivers, we cannot forget this. About 70% of long-term care is paid from unpaid caregivers. A lot of time we find this as female companions and female spouses that are providing that on the front side of a male claim. Now, when we talk about these services, we have to have an understanding about what they cost. Um, the Genworth owns a company called Care Scout. They've got a very vested interest in knowing what costs are. They are the largest insurer of long-term care. So by them knowing how much care costs, they can better control their expenses, be able to negotiate different contracts with facilities and so forth. You can look at this for anywhere across the country. If you just Google Care Scout, cost of care, you're going to be able to find the exact same information. You can narrow this down to zip code. And what Care Scout does is they just call facilities all day long and ask, what do you charge? So with that, I pulled costs in the state of New Hampshire. The most recent report is as of the end of 2025. For home health care, and this is non-medical care, long-term care is not medical services. The average on a monthly basis is about $7,627 in New Hampshire. When we talk about assisted living for a private one bedroom, we're at $8,025 a month on average. And then for private nursing care, we're right about $13,444 on a monthly basis in that care costs. Now, before we take a look at a planning scenario of a 60-year-old couple, if there are any questions on what long-term care is, how much it costs, where it takes place, and who uses it, now would be a great time for us to address some of those questions.
Bob, can you talk about the prevalency of adult daycare facilities? I've never seen one or don't know where any of them are at. Are they frequent in the community? Like who runs these and how do you find them?
Great question. They're not very common. And if you can imagine, the term adult daycare center is not something that we like to utilize. So you're going to see things more like senior centers. I'm in Parker, Colorado. We're a small suburb outside of Denver. We do actually have a senior center that does provide that adult daycare type service, but they are pretty uncommon. The place that we're seeing a lot more of their usage is working age individuals that have a need during the day while their spouse is working and so forth. But good question. They're pretty uncommon.
And who's the best who are the type of people that are going to these? Is it like if you're working and your parent needs care, you're dropping them off on your way to work and then picking them up on your way home? That type of situation?
That's exactly what it is. And usually their care needs are fairly mild. And sometimes they may not meet benefit triggers when it comes to things like long-term care insurance. For example, we have to be unable to perform two activities of daily living to qualify for reimbursement from a long-term care insurance contract. Well, I may not have a need for two activities of daily living. I may just need help every time I use the restroom. Well, that's going to only be one activity of daily living. So when I'm not receiving those benefits from the insurance company, I can then utilize that adult daycare, that senior center. They'll help that person use the restroom while I'm at work, significantly limits my out-of-pocket costs. And then, yes, on the way home, I'd pick them up.
Okay, gotcha. And you are writing insurance, long-term care insurance for people across the country and factoring in what the costs of long-term care are in different areas. Can you give us just a broad brush, like where is it higher? Are there certain regions where it's higher than others?
Oh, absolutely. We do a lot of work in Boston, Massachusetts. It is the most expensive place you could ever get long-term care. Secondary to that, San Francisco. If you're looking at conserving premium or actually expenses, Wyoming is a great place to retire. There are some instances where in some of those rural areas, costs for home care are significantly higher because that care provider may have to travel 60 or 70 miles just with a limited breadth of how many of those people are available. But typically, the more populated or congested the area is, usually the more expensive that care is, mainly just because of housing costs and so forth.
Okay, great. All right, thank you. That's all
Yeah.
for questions.
Absolutely. Well, now that we know what long-term care is, who needs it, where it takes place, and what it costs, let's take a look at kind of a planning scenario. So this would be a pretty common situation where here we're working with a male and female couple. They're both 60 years old. They're both in good health, and they're in New Hampshire. And what we needed to determine is if they need long-term care in the future, how are we going to be able to provide that for them? I always start with the cost of care. Okay, so again, in that 2025 Care Scout report, we had home care right at $7,627 a month. This accounts for 44 hours of care per week. On an assisted living basis, we're at $8,025 a month, and private nursing care, $13,444 a month. Now, there are a number of different options that they could potentially receive that care from. The first of which would be governmental benefits, Medicare, Medicaid. We could certainly talk about self-funding, those continuing care retirement communities or CCRCs, and then the insurance route, either using traditional insurance or hybrid type combo products. And then also, we're going to talk about what if they choose not to plan for this today, and maybe we come back to the drawing board in a few years. Let's start with the government benefits. Okay, so Medicare, this is something that typically everybody at retirement age is going to have. And there are some benefits in Medicare for long-term care. Now, the first thing we have to be aware of, I have to have a 3-day hospital stay before Medicare is going to provide anything to me. If I do not have a hospital stay, but I need long-term care services, Medicaid is not going to, or Medicare is not going to be an option for me. But if I do have a hospital event, I'm there for at least 3 days, then Medicare is going to be able to provide some benefits for me for a skilled nursing facility. If I go from the hospital into hospice for because I'm terminally ill, there's also benefits there. And then also if I need home care that is required for my medical improvement using skilled nursing therapy, there would be benefits for Medicare there as well. Here's what those benefits are. They cover the full cost for day 1 through 20. After the 20th day, they're going to continue paying days 21 through 100, a maximum of $217 per day. Once we've reached that 101st day, there's no more coverage. So Medicare is really not a sound solution for planning for true long-term care. One, we have to have that hospital stay, and most of us would agree that we can cover 100 days of care. Our worry is what if we need a 2 or a 3-year event? Now, Medicaid is something that is not available to everybody. This is available to people who have limited resources. And they define what those resources are. And in the state of New Hampshire for 2026, there's a couple limits that we have to be aware of. The first of which is our income. So if I'm a single individual or if I'm just one spouse and I need services, I can have income from all sources. This is required minimum distributions, dividends, interest, Social Security, pension income, everything that's out there. I can have no more than $2,982 a month of income. If I'm married and both spouses are going into a nursing facility, that income now goes to $5,964. Okay, now assets. These are how much I'm allowed to have, and this counts for everything. This is our IRA, this is our brokerage account, our savings account, personal property, all of those types of things. If I'm single, we're looking at $2,500 is what I'm allowed to keep in my assets. Everything else must be spent down before Medicaid would provide any options for me. Now, there is some asset disregard. This is unique for things like cars, specific gold and those areas, but typically even with that maximum 7,500. On the married side, if both people are looking at going into a facility, it's $5,000 a month, and then we're allowed home equity in the state of New Hampshire, 752,000. These are yes or no situations. It's not that we qualify for a limited breadth of benefits. We have to meet these thresholds. If we're over this, we have to spend this down in order for us to qualify for Medicaid. Now, we talked about this income, right? The $2,982. I'm not allowed to keep all of that. I have to spend that on my care when I qualify for Medicaid, but I'm allowed to keep $93 a month, which is called my personal needs allowance. It's things for like toiletries and so forth. Now, if I'm married, my spouse is allowed to keep some of that income as well. The minimum is $2,644. The maximum is $4,067. That maximum is dependent upon housing costs. So they look at what our housing costs are, all of those types of things to really be able to determine what do I qualify for in terms of income that my spouse is allowed to keep. Only covers skilled nursing facility. So with Medicaid, it's not going to cover care in our home. It's not going to cover care that is in an assisted living facility. This is truly skilled nursing facility. There are a couple of waiver programs. These waiver programs are designed for things like adult retardation and so forth. So typically, not a lot of benefits that you would find within that home and area. The other thing is if I transfer some of my assets, right? I think that I'm going to be going on Medicaid. I need to figure out how to get $100,000 to somebody. If I transfer that to my child or a charity or whatever the case is, when I file for Medicaid, they look back 5 years, 60 months. Any transfers that I've made in that time frame, they add back into my asset limit. The other thing to be aware of, when we pass, they seek reimbursement from our estate. So if Medicaid paid $100,000 in benefits and that home equity that they originally forgave that we had, that's going to fall within my estate. And when that does fall into my estate, they're going to seek that from me once I have passed. Now, another option, well, before I go on from Medicaid, this is a big question that we get quite a bit. It's really not something that many people are going to qualify for. The reality is if you're in a position where you can either self-fund care, you're working with a financial advisor, you can consider long-term care insurance, Medicaid's not going to be something that really qualifies for you. It's really for people of extremely limited resources. Now, the other thing that this couple could do is they could look at self-funding their care. Okay. We looked at long-term care insurance. It was expensive. We decided we didn't want that. So we're just going to cover the cost for ourselves. Here, I'm using that same cost of care data. Home care, 76.27 a month. Assisted living, 8,025. Nursing care, $13,444. And what I did is I created a couple of columns. What does that look like monthly and what does that look like annually here in 2026? If we look at assisted living care, about $96,000 a year, and home care about 91,000, I think those numbers are very similar to each other. So that would kind of be the planning for home care and assisted living. And then nursing care is about $161,000 a year. Now, keeping in mind that these are 60-year-olds, if we focus on how does this look when we're 85, I'm just going to use a 3% inflation factor. In 2051, these numbers would grow to 191,000, 201,000, and $337,000 a year. So when we do self-fund this, we have to be aware not only of the current cost that we have to have resources set aside for, but also making sure that there's some growth to be able to handle that. Now, what I wanted to do is say, what would a long-term care event look like? Okay, and let's assume that we needed assisted living. I've broken this down into a number of different year scenarios. We've got 2 years, 3 years, 4 years, and 5 years. We'll just focus on this 3 year scenario. So in today's world, if one spouse needed a 3 year care event in an assisted living facility, that total cost is going to be about $290,000. If both spouses needed that, it'd be about $577,000. So for this couple, if they were to say, we truly want to self-fund long-term care, the appropriate thing to do in today's world would be to allocate $577,000, specifically earmark that toward long-term care, having some of it immediately available, some of it to where we're not dealing with large capital gains or odd asset liquidation situations if we needed that money in a year or so forth. And then just being able to plan to make sure that that grows over time. We'd want to target that balance reaches about 1.2 million in order to be able to account for that at age 85. In my practice, we see a lot of people that look at handling the self-insurance route. And once we decide, I would really have to set aside 577,000, just the opportunity cost of where that money is currently in their portfolio. A lot of times it makes sense just to use some of the dividends, interest, or really rate of return that we see on the asset to use it to fund long-term care insurance itself. But this is truly what an option would be if they chose we're just going to self-fund this. Now, when we talk about continuing care retirement communities, okay, these again are effectively, in my mind, more an alternative to long-term care insurance than it is something that really cooperates with long-term care insurance. We've done some research in the state of New Hampshire. There's a couple key communities out there. Riverwoods Communities has multiple locations, Hunt Community, and then also Covenant Living of Neem. All of these have independent living included, and that's typically where we start. These usually are not an option for people that already need care. Okay, these are options for people that say we're 70 years old, we've decided we're going to move into this independent living, we like all the activities that they have and so forth. And now if my health progresses negatively, then I can get assisted living services, I can get memory care services, and I can get skilled nursing care services within that facility as well. These come with a cost. Okay, first we have an entrance fee. When we talk about these entrance fees, this just kind of depends on different facilities. This is Riverwoods for 2026. A studio is 237,000. One bedroom just depends on the facility you go into and which one you choose. 286,000 to 462,000. Two bedroom 569 to 735,000. Single cottages are just over $1 million. So this is what we pay as an entrance fee to go into the facility there. Some of these are refundable, some of these are not. Usually the refundable is going to be on the higher side. So they say, well, it's 286,000 for a one bedroom if it's non-refundable. If you want it to be 90% refundable, that would be your $462,000. And if there is a second person that's going, typically they have a fee. Those are non-refundable when we have a spouse that goes in with us. Now, outside of that initial money that we put in to move into that facility, we also have monthly costs. The average of these facilities is right about $7,300. Think of this as rent, mortgage, and those types of things. This is truly your monthly housing costs. We see some of these facilities easily can go up to about $9,000 a month. But this is really a solution for individuals that say, we know that we're going to have to pay our living expenses. We understand that if we bought a condo or a home somewhere else, we'd have to put a down payment or pay for it. And if our health progresses negatively and we start needing some of these other services, we like the fact that it all can be within the same place. They can transition me within the same location. And instead of me dealing with going to an assisted living facility or nursing facility externally, I just do it all within the same place that I'm living. Now, one of the key issues that we face when it comes to CCRCs is how they coordinate with long-term care insurance. In long-term care insurance, it reimburses us for the additional expenses that we incur because we need long-term care services. Well, if my monthly cost is $7,300 and I go to assisted living and my new monthly cost is $7,300, I have no additional expenses. So it's very difficult for the insurance company to say, well, your costs and your expenses are the exact same now, so how do we reimburse you the additional? Where this really comes down to in these CCRCs, if you do have long-term care insurance and you're looking at using a CCRC as an option for you, it's important to understand how their billing looks. Some CCRCs, when you go into an assisted living facility or memory care or skilled nursing facility, they do itemize their billing. And now we're able to show the insurance company, this is how much I'm paying for my care. This is how much I'm paying for my room and board. You're going to reimburse me for the care side of it. So if you do consider a CCRC and you have long-term care insurance, or you're determining between the difference, I really suggest that you understand that these are kind of an alternative to long-term care insurance, not something that you'd keep in addition. If it is something that you have both, it's a good idea to make sure you understand how that billing looks. This is an area that oftentimes people will have some questions. Jonathan, I'm not sure if you've seen anything come your way to this point, but before I move into the insurance side, happy to answer any questions thus far.
Yeah, we had a few questions. One was about the tax deductibility of the entrance fees and ongoing living expenses, and I just said that typically it's the CCRC that provides a letter giving you those numbers for how much is tax deductible.
That is true, and I hate to handle that standard. Consult with your tax advisor. There's no black and white answer here, and you're absolutely right. Some of the areas are deductible. They do generate that letter that helps understand based off our facility. This is what that looks like. Usually the primary entrance fee is not tax deductible, so that this initial 237,000, in the same way that if you purchased a home and paid cash for it, there's no tax deduction there. It's really that second person that comes in.
Yeah. You answered the can you use long-term care insurance to cover CCRC costs? That was a question, but I think it depends, and it's kind of situation dependent. Is that true?
It is, and the key thing that I would suggest if somebody has long-term care insurance or they're really focused on this is going to be a part of my long-term care plan, is this insurance contract. When you're evaluating CCRCs, most of the time we find people are narrowing it between two or three different facilities. It's a great idea in the interview and evaluation process to ask how they handle that. Um, the facilities that are real quiet about answering that question usually is an indicator that they don't separate that billing. And that's kind of the key in coordinating with an insurance company is making sure that those services that are being provided to you are separate within that billing side.
Okay. Do you ever recommend people just get rid of their long-term care insurance once they enter the CCRC?
It's very rare I've made that recommendation. There are a couple adjustments that we look at. Number one, and we'll see this as we start talking about long-term care insurance itself. Inflation is a huge component of the pricing of a long-term care policy. Oftentimes, if we know that there's going to be a base layer of coverage that we want to have, or even maybe just some additional home care that may be more available to us, that we don't need to progress to the assisted living side of the CCRC. Oftentimes, it makes sense to maintain that policy, potentially removing the inflation protection. And let's say it's grown to $12,000 a month of benefit. And we're really just focused on, I just need $3,000 a month. So if I do need additional home care and I don't want to progress to assisted living, I've got that flexibility. We can make some downside adjustments to be able to conserve premium and then better align that coverage with the support they would need on an independent living basis.
Yeah, it's a great point about the home care because that's not typically covered by the CCRC contract.
And very limited, for example, in a CCRC, if let's say the services the person needs is getting out of bed and taking a bath, they're going to have a home health care person show up for 30 minutes in the morning. Well, it may be more appropriate that we've got that person there for 3 hours, and that's where that private insurance can fill that 2.5 hour gap.
All right. This is going back to the Medicare. Do you have to be in the hospital for 3 days before Medicare covers hospice?
Yes.
Okay. And then another question about just long-term care expenses in general. And do you feel like there's inflation of the cost of long-term care because of any deportation policies that have been happening in the country
I've
related to
not
who
seen
works in these facilities?
I think that's a great question. I will tell you that the impact of that is so fresh that we've not seen any real world examples of that. What I can tell you, the biggest thing that we're seeing in escalation of long-term care costs is changes in facilities. I mentioned to you, I'm in Parker, Colorado. We're a suburb of Denver. Um, Parker's not huge. I think we're about 70,000 people inside the town limits. 10 years ago, we had one assisted living facility in the community. Right now, there's seven. We've got over 1,000 beds, and part of that is it's an affluent community. A lot of times, we find that as people's parents need care services, they're moving them closer to where they live. But we've seen a huge inflow of these new facilities. Morningstar, is a large provider of long-term care services. Look into their financials; they're doing really well. And part of what happens is when they build a new facility, they don't put in avocado color counters. They put in granite. They put in good Wi-Fi systems. They have, a ice cream shop that's a little bit different than, kind of standard. And that's some of what we're seeing and tied to those construction costs as well. Just kind of building some of this infrastructure and the updates. That's the biggest thing we've seen. Now, when we start talking about long-term care insurance itself, you're going to notice 3% compound inflation. And in truth, every policy that I've sold has 3% compound inflation for the past 10 years. Prior to that, everything had 5%. There's no reason for that. other than affordability. Okay. What didn't happen is all of a sudden long-term care insurance expenses quit inflating at 4% or 4.5%. Consumers said, I can't spend double the price of my policy to have 5% compound inflation, so I'll go ahead and go with 3% compound inflation. I do think that we're going to continue seeing as this infrastructure is built out and in facilities to handle the numbers of people that are going to need long-term care. I do think it's going to accelerate more than what it's done in the past. And that's a good point. Some of what we may see from a labor perspective may certainly impact that. Even if it's just individuals kind of getting, current certifications and their wage expectations today are higher than what they were 5 years ago, for sure.
All right, thank you. Good to move on.
Perfect. So let's talk about long-term care insurance. Okay. On the right here, I've got an illustration from National Guardian. National Guardian Life right now is probably the most competitive carrier when it comes to long-term care, and I would say 85% plus of experiences. The way that a long-term care policy truly works is you're buying a pool of money. And the way that they develop that pool of money is by taking the benefit amount multiplied by the benefit period. So in this case, what you're going to see is we've got a monthly maximum benefit of up to $9,300 a month. And we've got an elimination period of 90 days. This is how long we need to qualify for services before they start reimbursing us. And then we have a 3-year benefit period. So really what we have is $9,300 times 36 months to give us $334,800. Now that's available for spouse number one, the same thing for spouse number two. Now, a unique aspect to their contract, under their shared policy rider, there's actually a third pool of money that equals this as well. So really, this contract provides $334,000 times three, just over $1 million of benefit. This says if spouse number one goes on long-term care claim, they can get reimbursed up to $9,300 a month. Now, if let's say their care expenses are only half of that, they don't lose what's in that pool of money. Okay, that's still going to be within that 334,000. It's just going to last 6 years as opposed to 3. So it's not a use it or lose it situation. But if let's say this client uses all of this 334,000, they're going to have that third shared care pool that's an additional 334,000 that they can continue drawing with on. So each spouse here has a maximum of 664,000 or 668,000. However, if one spouse uses that full shared pool, the other spouse is only going to have access to their own money. So this basically creates, again, about $1 million. Now, the reason I use this $9,300 number is that's 70% of the cost of nursing care. So if we take that nursing care monthly expense times 70%, that's typically what we target insuring people at. We understand that if we were to insure 100% of that, the policy is going to be significantly more expensive. And most people are okay with a risk sharing scenario on the nursing care side. And this typically is going to cover the majority of assisted living costs. Now here I've got 3% compound inflation included, which means this $9,300 a month inflates at 3% on a compound basis. The first inflation adjustment is year 2 of the policy. So when we look 15 years down the line, this is really going to be $2.3 million worth of coverage because of that inflation adjustment that's been included within that. You're going to notice the total premium here, $11,955. Of that, $4,300 is for that inflation component. So inflation really has a large impact on what that pricing actually is within these contracts. If we were to go to, say, a 4-year benefit period, that's just going to be $9,300 times 48 months. That's a pool of $446,000 per person. With that shared pool, it's now right at $1.33 million in coverage. Key thing here, our age. 60 is a little bit on the backside when it comes to planning for long-term care. 10 years ago, the average case that we wrote in my office was between 60 and 65 in age form. Right now, we're more lower 50s. We're seeing more and more people in their 40s implement coverage. And a lot of that is just affordability. If we were to rewind these people, say 5 years ago, this premium might be something like $7,000. But they do provide coverage on a reimbursement basis. So if we do qualify for claims, so we're unable to perform two activities of daily living, and let's say I need someone to come into my home for 3 hours a day, they're charging me $100 for that. I'm going to pay the home health care agency. At the end of the month, I provide proof that I've made those payments to the insurance company. They're going to give me a reimbursement check. Now, indemnity contracts, instead, what they say is as soon as you qualify for claim, we're going to go ahead and just send you that $9,300 every month. These contracts really don't exist anymore. There are some combination or hybrid products that pay on an indemnity basis. But what was happening is people go on claim and they use all of their money in the first 3 years. They didn't have those expenses and they were spending the money on something else. We actually have a claim in my office that the family had gone and found a garage full of QVC boxes, and they were just consistently taking the money that was coming in and buying gifts for their family and leaving them in the garage. We talked about inflation protection. Key thing with traditional long-term care insurance, you're paying only the cost of insurance. So there's no component for also buying life insurance or trying to build some type of cash value. This works in the same way as every other insurance policy out there. We pay a premium if nothing happens to us. The insurance company does better than we did. In the alternative, if we need care, the insurance company reimburses us, and typically that's where we do better than the insurance company. Now, when we look at this $11,955 premium, by nature, this is a level premium, which means this doesn't go up. So next year, when the benefit goes up because of the inflation, our premium does not. 5 years from now, the benefit's even higher because of the inflation. This premium does not go up. However, the insurance company has the ability to go to the state insurance commissioner and say, listen, when we sold this policy to this 60-year-old couple back in 2026, we made some assumptions. Okay, we thought that we would get X percent rate of return on our invested assets. And what we've learned over the past 5 years is we haven't gotten that rate of return. We've gotten a lower rate of return. We also thought that 1 out of every 100 people would cancel their policy. We would keep their premium and we would have no ongoing liability. But what we've learned is only 1 in 200 have canceled their policy. So we're maintaining more risk than what we thought. And we also thought that out of every dollar that we brought in, we would pay 70 cents in claim. But what we've learned is that number is actually 71 cents. And if we do not get more premium to come in, we're not going to be able to honor the promises. And they've got to provide a whole bunch of data to the insurance commissioner. The insurance commissioner then says, yes, we approve the rate increase. We don't approve the rate increase, or we're going to make a modification to the rate increase. My belief, every long-term care policy out there is going to see a rate increase. Whether it was purchased 10 years ago, whether it's purchased today, I believe every contract is going to see a rate increase. It's just a matter of what that looks like. And we'll talk about that in greater depth here more once we get through some other insurance options as well. But we should expect that this 11,955 is going to go up. Now,
One question before you move on.
yes.
Even, even though you have the benefit period stated there is 3 years, it can extend beyond that if they don't spend out the whole $334,000 pool, or if it's
Oh,
shared 700,000.
Absolutely. And keep in mind, so with National Guardian, they actually have a third pool of money. Their illustration does a really poor job of showing that. But this shared pool that we see down here is actually a whole nother $334,000 pool. But let's just as an example, and the other thing to be aware of too, it still inflates while you're on claim. So even if you had $9,300 a month for 3 years, it's really going to pay for 3 years and 2 months because of that inflation. But let's say instead of my care being $9,300 a month, let's say it's $1,000 a month. This pool of money would last 334 months. Okay. So it's not that we lose anything that we don't spend. Now, in the alternative, let's say I need $14,000 a month of care. They're only going to reimburse me 9,300. I cannot get access to the additional money in my pool of funds because there's money there. I'm still limited in what I can take on a monthly basis, but I do not lose it if it's not used. And most claim scenarios, Jonathan, actually start home care. In home care, it's pretty rare that we'd be at $9,300 a month. Usually we've got someone coming in for 1 or 2 hours a day. They're billing us $1,500 at the end of the month. We pay that $1,500. So the front side of a claim is usually significantly lower. Now, then over the next year or so, it progresses. Now we're up to $7,000 a month. And the care coordinator says, you might want to go into an assisted living facility. We've got someone in your house 7 hours a day, 7 days a week. This may be a more efficient place for you to be able to receive that care. And if they do that, that's when now we're at that $9,300 a month in benefit and expense.
Okay. And does individual health play a role in premium costs or even getting insurance in the first place?
Yeah, getting insurance, yes. So you're going to notice in this quote up here, I've got rate class. With National Guardian, it's pretty confusing. It says Premier. That's a yes. If you're not Premier, you're declined. They have one rate class. Now, Mutual of Omaha, they have four. And I'm going to argue against that. They'll tell us that they have four, which is their preferred rate class. I haven't seen someone get preferred with Mutual of Omaha for 4 years. I don't think it's true that they offer it. Okay. I could be 45 years old in absolute perfect health, and they're going to come back and say, sorry, we gave you our standard rate class because your blood pressure 2 years ago at your doctor's office was 135 over 81. We just don't see that they truly offer it. They have their standard rate class, and this is where we see almost every approval come out of Mutual of Omaha. Then they have what's called a class one, which is a 25% premium surcharge, and a class two, which is a 50% premium surcharge. Maybe somebody had stage two breast cancer 8 years ago. They're willing to offer them coverage because there's been no reoccurrence, but they're going to add that 25% premium surcharge, and they would approve them at that class one rate class. 10 years ago, that happened. Now, what we found is the insurance company just doesn't want the risk. To be truly forthcoming, insurance companies don't want this business. 10 years ago, we had 15, 20 carriers that were offering long-term care coverage. Right now, we have four. National Guardian's pretty unique in the scenario. Their book of business is a very profitable, what's called final expense insurance. It's expensive whole life insurance that pays for funeral. These are people that pay $100 a month in premium for $10,000 of death benefit. They buy it at 65 years old. They die at 70. They've paid $25,000 in premium for a $10,000 death benefit. That's the majority of National Guardian's book of business. In 2018, they said, we think we can come into the long-term care market and do really well. We don't have these policies on our books that are grossly underpriced. And I'll tell you, we've got contracts in my office where couples are paying $4,000 a year, and they've got $2 million of total benefit with 5% compound inflation. In today's world, that policy would be $30,000 a year in premium. It's just significantly underpriced in some of that older stuff. But
Right.
National Guardian said, we're going to enter the market at a point where we can have these premiums at 2026 costs, and we don't have all this pollution on our books. But it is difficult to get. Health, they're going to find reasons to decline us. The decline rate over 60 right now, we're seeing issued with carriers about 50%, but that only accounts of actual applications that are submitted. We'll talk about the application process a little bit here in my office, but most people should be doing a good job of pre-underwriting their individuals that they're considering to determine can you or can you not get coverage. But if it falls in any of those odd premium classes, we're typically not seeing them actually approve that case.
What type of health conditions would do you see that are absolute no's?
Uh, weight bearing location fractures, two of them are big ones. Diabetes is difficult. Type 1 is uninsurable. Type 2 depends on how A1C treatment's gone. Any cognitive mention whatsoever. And I'll tell you, we had a guy get declined because he went and joked with his doctor, and he said, well, my wife thinks I'm losing my mind because I don't listen to her. Yeah, this was a guy that sings opera in multiple languages. He was declined. He came back and said, listen, I'm Mensa. I've got an IQ of this. I sing opera in all these different languages. And you guys are telling me you're not going to give me long-term care insurance because I was joking around with my doctor. He ended up going to get a full mental health assessment and doing additional testing. And ultimately, we got that decision reversed. but anything cognitively whatsoever, that's an issue. The other thing that we run into is family history. Family history is starting to become more and more relevant in long-term care underwriting. 10 years ago, they didn't even ask the question. Now you're in a situation where family history, if we've got two people, either mom, dad, sibling, or grandparent with Parkinson's or Alzheimer's, we're going to be a decline across the board. And I'll kind of overshare. I'm 48. My wife and I, we own long-term care insurance. We bought it 3 years ago. The reason is my mother-in-law was going through Parkinson's testing. We knew the moment that she was diagnosed with Parkinson's, my wife would become uninsurable. So we are starting to see some of those types of issues. And again, you go and you get a bone density test, and the doctor says, "Up, we think you got osteopenia. We'd like you to get on a calcium supplement." And then a year later, now it's progressing, it's osteoporosis. They slipped and fell and fractured their ankle. That person's uninsurable. There really is a larger list of things that would cause someone from being uninsurable than a list of things that makes them insurable. Carriers are really looking for young people in great health.
All right. Thank you.
Now, there's some things that we don't like when we talk about this. Okay, $11,000 is a large premium. I told you the premium is going to go up. Okay, consumers will consistently say things like, "Well, what happens if I never use it?" Well, it's just like your home insurance. It didn't burn down. You didn't have to use your home insurance. But what happened was the insurance industry was going to sit at kitchen tables and tell people about their long-term care planning, and they've got this wonderful insurance policy. And then these consumers said, "Well, you told me it's going to go up in price. You told me if I never use it, I just lose all the money. This doesn't sound very attractive to me. I don't think I'm going to buy long-term care insurance." So the insurance industry came up with what's called hybrid long-term care insurance policies. This is a combination of life insurance and long-term care insurance. And these originally came out with single premium. Okay, so you give me $100,000, and if you die, I'll give you back $130,000. Okay, so you don't lose any money. You get to pass it all on to your beneficiaries. If you don't die, but you want to change your mind and you want your money back after 10 years, I'll give you your money back. I'll give you all $100,000. So right there, we've already talked about the opportunity cost. The insurance company used your money for a decade, then you get back exactly what you paid them. You didn't have any growth on that money for that entire decade, and it works out great for the insurance company because now they no longer have the risk. But if you do need long-term care, we're going to leverage that 100,000 by three, and now you have $300,000 of long-term care. Well, that type of structure doesn't have inflation coverage. The moment we add inflation, it doubles the premium. So now we're talking $200,000. But then we've got a husband and wife, so now we're talking 400,000 between them. My general position is this. Take that 400,000, leave it with your financial advisor. Have them come up with a rate of return of 3% and use the $12,000 that it generates to buy traditional long-term care insurance. Now, if you do go on claim, you've got the insurance in place. If you use everything that's available under that long-term care policy, you still have the underlying asset that you can continue funding your care. If you cancel your long-term care policy, you still have that asset. It's just is the same. The insurance company didn't use it for that time frame. You did. It was still there for you. And if you die, that money, that asset's still going to pass on to your beneficiaries. So you're able to do the exact same thing as these contracts did. Well, what happened was once they got through everybody that had a couple $100,000 laying around for these policies, then they said, okay, now we need to let people pay for it over 7 years. They got through all that money. Now, how about 10 years? Now there are hybrid products out there that are 20-year pay products. So we pay for 20 years, fully fund it. It actually takes more premium in than what we'd see in those single premium. And the new thing that we're starting to see is combination products. This is where instead of there being a small death benefit with leveraging for long-term care, instead it's a large death benefit. So now they're selling you even more life insurance that you don't need because you've got a long-term care exposure. But you can access that death benefit prematurely if you need it for long-term care services. I am not a fan of these. I think they're extremely inefficient to the consumer. They're very lucrative to the insurance person. It's probably for somebody that knows how to sell the easiest thing to sell because it's palatable on the consumer's ear. Your premium's never going to go up. If you change your mind, I'll give you your money back. And if you die, I'm going to pay all your money to your beneficiaries. And if you need long-term care, we're going to give you long-term care money too. They just don't understand how unbeneficial it is to the individual because it's significantly better to the insurer broker. It pays insurance agents about 3 times the amount of commission we get on traditional long-term care products. It is extremely inefficient to the client. If this is something you have some questions on, I've got a detailed article on my website. It's just advisorinsuranceresource.com. There's a knowledge base section and then understanding linked benefit products. This is something that we did finalize last year. Excellent resources if this is something you had some specific questions on. Before I talk about the cost of waiting, are there any questions at this point specifically related to traditional long-term care or hybrid long-term care that I can touch on?
No, just with the if you have a chronic illness rider on any type of insurance, because it's not just these hybrid products that have that rider on them, I believe. Is that true?
It is. So there's two key riders. There's critical illness and chronic illness. Okay. Critical illness is going to be our long-term care. 2 activities of daily living is our benefit trigger. Chronic illness, our doctor says you're going to die. If we're going to die within 12 months, we can accelerate death benefit. So if I'm not terminal, but I'm unable to perform activities of daily living, that's where that critical illness is going to fall in, and that's the rider that we're talking about.
Okay, gotcha. And can hybrid policy premiums increase?
No, they can't. That's one of the key things with them because they're built on a life insurance chassis and they work on guarantees. They cannot. But here's basically what's happened is you put the money in, the interest that you'd normally get on a permanent life insurance policy that builds that cash value, these don't build cash value. Instead, that siphons off to cover the long-term care side. And they're almost always sold with no inflation because it truly doubles the premium. The number of hybrid contracts that an advisor's put in front of me with inflation is seriously one in my entire career. It's just not sold with inflation.
Okay. That's all we have for questions right now. Thank you.
So one of the big questions is when's the best time to buy long-term care? Yesterday, 100% of the time. The only time I will take that away is if you're under the age of 40. Carriers, there's been a couple of legislation issues, mainly Washington state came out with a state program that you had to have some long-term care to opt out of a state tax. People were 30 years old and buying a tiny policy they kept for a year just to be able to opt out of that. The industry now said, nope, you've got to be 40. So if you're over the age of 40, long-term care is typically something that it makes sense. Key things, premiums go up with age. More things can happen in our health that we lose those discounts. Product evolution is a big one. The National Guardian that we looked at is their Honest LTC product. It was released in January of this year. It prices 9% higher than their previous product. So if I waited a couple of years and a carrier comes out with a new product, I'm going to pay that higher price. Doctor finds something, I slip and fall, I have that weight bearing fracture, whatever the case is, I've got a bigger chance of being denied. And then if something does happen to me, I just don't have the coverage in place. Now, same thing here. My website, knowledge base, when you look at long-term care, the true cost of waiting, this is an extremely extensive article if you're really wanting to understand what if I wait a couple of years. But to give you a basic example, so we're looking at the same male and female couple here. They're 60 years old, and on the left side, it's that 11,955 that we talked about. I said, what if we have these people wait? We're going to take them a couple years down the road. Well, the first thing we have to be aware of, we've now got to buy a larger benefit because 5 years have gone by. So I need to buy a larger contract because that 3% inflation would have raised my benefit from $9,300 to $10,800. Okay. Just me buying that additional benefit now has my price at $17,787. Okay. Because I'm age 65 versus age 60. So my price, because I'm 5 years older and I have to buy a larger contract, 17,000. So what we look at, our price increases about 9% a year. We also have to buy that additional coverage. So now we're at 10,800 versus 9,300. That's just based off that 3% compound over 5 years. And this doesn't account for product evolution. Okay, this is the Honest LTC product that is available today. But in some states where we don't have the Honest LTC product still in place, they would be looking at the old product that was 9% less expensive. This 17,000 is going to be even higher. What I've kind of come to realize is that carriers want the same amount of money by a specific age. Whether we start funding it at 65 and they get that money by 75, we've got 10 years to fund that. just as much as it's easier to save for retirement if I start at 40 than it is if I start at 50. Same type of thing here. And the big thing really that we've got to be worried about is becoming uninsurable, because then our only options are Medicare, which we've discussed is not going to be valid for us, Medicaid, which is not going to be valid for us, self-funding, which is now the only option I'm stuck with, and I've got a limited time period to be able to do that. Now, talking about long-term care insurance
Hey
itself.
Bob, what was
Yes.
the product before Honest LTC, and why did it go up by 9%? Is it a better coverage or
Nope, it's worse. So, carriers, whenever they come out with new products, and their other one was just called LTC One. Mutual of Omaha is a great example. They are now on their third generation product. They strip ancillary benefits, things that people don't know. Okay, so for example, respite care. If I'm in a facility and I need to go to the hospital, how long does my policy continue to pay for my bed when I'm not in it? 10 years ago, every policy was 60 days. Now every policy is 30, except Honest, it's now 20 days. Okay. They took 10 days of respite care away. Nobody would know that. And in my experience, most brokers that sell this contract don't know that that difference exists as well. They might change from international care, saying we'll cover up to a year of home care, assisted living, and nursing care, to saying we'll only cover nursing care on that international basis. That's something we also saw change with the Honest Care product. So they usually strip benefits that most people are unaware of. And it's the way that they're also repricing their product to account for, current assumptions, interest rates, inflation, and those types of things. It's just really common in this industry. And usually the life cycle of a product is somewhere between about 5 and 7 years.
okay, thanks.
Mhm. When we do talk about long-term care insurance, step one, a good insurability assessment. What we do in our office is we understand full health history, what medications, what diagnosis, and so forth. We've got a couple different ways that we can obtain that data. From there, we determine of all the carriers that we work with, are we insurable? If so, then we generate a side-by-side comparison, determine who's the most competitive company. And then that's where we're going to look at any type of adjustments. Maybe somebody that has a large net worth and says, well, we can take on the inflationary aspect. We want a lower premium, but we want something to be, a foundational level of coverage. Once we've decided what that design looks like, we go through the application. Typically, they're going to ask us questions over the last 5 to 10 years. Have you been diagnosed with any of these? What are your medications? And so forth. Usually, there's kind of a catch-all question. Other than what you've already told us, anything else ever that you have talked to a doctor about? Once they receive the application, first thing every carrier does right now is they order medical records from primary care physician. They used to do medical exams. They no longer do that. Now they just pull medical records and see what's inside of those records. If we haven't been to a physician in the past 2 years, they're going to order that medical exam. About 50% of the time. The other 50%, they say they need to go get a physical with a doctor. They just don't want to spend the money on that exam. And then they render a decision to approve or decline the policy. If they do approve the coverage, you've got 20 days by law to accept that contract. Most carriers will extend that without question. So then we just put that policy in place. Now, rate increases. This is kind of an area where um, there's a lot of disagreement in my industry. Okay. If on this call right now, National Guardian or Genworth Genworth would say they're going to increase their premiums, but anyone that's currently selling product, they would say, don't listen to Bobby, doesn't know what he's talking about. We've repriced our product really well. We're comfortable with all the assumptions, and we think our past pricing mistakes are no longer going to be the case. My belief, every policy is going to see rate increases. What I suggest is any policy that's being purchased today, we plan on a 2 to 3% compound increase in premium. Now, because they have to go through that approval process with the state, this isn't something that's going to happen every year. It might be something like a 42% increase in the 10th year. It might be something like a 18% increase in the 7th year. We have no idea. But we absolutely should implement coverage understanding 2 to 3% compound. For older contracts, I think that number is more like 3 to 4%. We're constantly wrong here. Okay, as an example, Genworth in Massachusetts in 2024, they did a 50% increase. Okay, I get these letters about 3 times a week. This is just my impacted policies from this rate increase in 2024. They're showing what the old premium was, what the new premium is, how many phases. This is basically comes in over a 2-year phase. So the state said we're not going to let you raise it this percentage over 1 year. We're going to have our consumers make this a little bit more palatable. We're going to stretch it over 2 years. But you're seeing these policies go from $8,000 to $12,000 in premium. Some of these contracts, look at these down here, $1,400 a year to $2,200 a year. These are those grossly underpriced policies that right now are 20 and 30,000 in premium. But my suggestion is if long-term care insurance is something that you either own or it's something that's a part of potentially how you would pay for long-term care, we have to model that within our financial plan that this premium is going to go up. If I'm wrong, great. But I do think that it's not a prudent to take the approach that carriers are, which is saying we don't think we're going to raise these increases or raise these on existing policies. One of the things that they're also telling us, underwriting is very strict right now. In truth, long-term care insurance is difficult to obtain. That's why it's truly, the younger we are, the better before these health issues surface. They say they're underwriting so strictly right now that they think that's going to help rate increases. Their assumptions are pretty low and so forth. I do think there's a bit of that is true, but the reality is these prices are going to go up. And if you've got a contract in place now, 3 to 4% is a pretty good assumption on a compound basis.
Bob, when people that have gotten long-term care insurance in 10, 20 years ago, and they have really rich policies right now, get these letters, what options do they have for not paying the rate increase? Can they adjust the policy to have a lower increase?
They can. So anytime there's a rate increase letter that goes to a consumer, it automatically is going to include three alternatives. The carrier tries to give them what's called landing points of how they can get the premium more close to what it is. An example, you may have a contract that has 5% compound inflation, and they'll say, if you will change your inflation to 3.2%, we'll keep your premium about what it is. Or you have a 4-year or a 48-month benefit period. If you change that to a 31-month benefit period, your premium will stay about the same. Or you now have $9,300 a month in benefit. If you change that to 7,100, your premium will stay about the same. Um, my office is pretty unique when it comes to long-term care, and I think a big reason of that is we really help people understand that this premium is going to go up. I mean, in this 2024, you're going to see most of these are 2012 to 2014 contracts, and this was the first increase that they had. But my consumers are aware this premium is going to go up. When we talk about people reducing their contract, they're really helping the insurance company. They're de-risking their portfolio, right? Now, if I don't have to have a 5% inflation for you now, 3.1, that does better for the insurance company. So it's a way that they also are able to kind of de-risk what they have in terms of product. In my office, what we do is we first pull a cost of care report. And what I'm trying to determine is, has that 5% compound or 3% compound you've had on this made it now to where your benefit is significantly higher than the amount that we would recommend somebody would have? Right now we're recommending 9,300 a month in New Hampshire. If let's say your policy is already at 12,000, well, that might be some planning opportunity. Maybe we reduce it from 12,000 to 9,300. Or maybe we say, you're 78 years old. If we take the inflation component completely off, we're going to reduce our premium to even less than what we're paying now. And the benefit's going to kind of catch up to where, or really the costs are going to catch up to where your benefit is over the next 5 or 6 years. So I always start by looking at where is the policy today compared to what we tell a consumer to implement. Most of the time, we don't make policy changes. I also get a pretty good number of emails and phone calls that say, Bob, my client got this rate increase letter. It's 60%, and I need you to get him a new policy. 100% of the time, they're going to keep what they have. I mean, that's my
Yeah.
one sentence. Now, I'm happy to get on the phone and walk through and show you why. But when you look at these policies, I mean, these ones I've got circled here, this $2,100 premium. I mean, I bet you if I pulled this up, this is in 2013. Yeah, this is probably 750,000 $1 million of benefit. And if I go to the market today, this is going to be $20,000 a year in premium. So we
Yeah, they
say,
don't know.
Yeah, exactly. It's just 100% of the time what you bought yesterday is going to be the better thing for you. The only isolated times that's not true, a very uncompetitive carrier in long-term care is Northwest Mutual. We don't see a lot of market penetration from them right now, but if somebody put in front of me a Northwest Mutual policy that was purchased 2 years ago, we're going to do better in premium. That's about the only circumstance that I would say we can do better than what you currently have.
I want to say that on a recent one of these letters, one of the options gave the policyholder a guarantee that the rate won't go up in the future. How
Yeah.
guaranteed is that guarantee?
Very. I mean, they have to do what they put in writing. I mentioned to you de-risking. De-risking is a big issue. Genworth is huge in this. Okay, Genworth sues themselves. Okay, they find three policyholders. There's been five class action lawsuits. They find three or four policyholders, and they basically come up with a class action lawsuit that says, we've done nothing wrong, but your premium went up, and there's some people that say we didn't really adequately tell you that your premium would go up, even though it's in bold in the application and so forth. We're admitting to no wrongdoing, but here's what we're willing to do. We'll allow you to place your policy into non-forfeiture status. Now, what non-forfeiture is whatever you've paid in premium becomes your new benefit pool amount. Okay, so if I've paid $40,000 in premium, I can make it to where I never pay you another dime of premium. You can never ask me for more money, but my benefit period now, or my pool, instead of being 334,000, whatever it was, is now $40,000. We're seeing a lot of people do this, mainly people that their agent or broker is no longer in the business, or they don't have a financial advisor to help them kind of counsel this, and they just don't want to deal with the premium. Well, that now changes it that the risk to the insurance company is only the money that they've actually received from the individual with zero leverage. It works really, really good for the insurance company. So we're seeing some of that. The other thing that they're doing is exactly as you said. If you take this option where your inflation goes to 0%, your benefit amount or your benefit pool goes to 15 months instead of the current 48 months, we guarantee you that we won't raise your premium for 10 years, or we've seen some come out of Genworth that they guarantee never premium increases again. Those are all things that sound really attractive to consumers. The thing is, they're only working to the advantage of the insurance company. They're really trying to figure out a way, how do I eliminate $1 million risk, for something that we're only taking in a couple $1,000s a year of premium.
Gotcha. Okay. We had a bunch of questions come in here. Is it possible that insurance companies will reduce your premium if they develop a cure for Alzheimer's?
No. Uh, I've been in this industry since 1996. I only deal with life, disability, long-term care. We do some annuity work as well. Not a single time in my career has an insurance company reduced premiums. There's just no reason for them to. Um, and what I will tell you though is it certainly could have an impact on new business pricing. What we're finding that happens medical wise right now is they're elongating issues. They're not curing Parkinson's as of today. They're figuring out how people live 8 years instead of 7 once they get a formal diagnosis. So that type of progression is actually hurting pricing in the insurance industry because now they're going to be on claim longer. Let's say though that today we watch the news tonight and they say no more Alzheimer's. We've got a shot that you take at the age of 45 and you'll never get Alzheimer's. 20 years from now, they're going to show that in that claims data that those people have aged and they're not paying for it. That's where we're going to see reductions in new business premiums, but nothing that they would do on existing contracts.
All right. Are there problems if you have long-term insurance in place with an insurance company who has gotten out of the business?
The No, in truth, no. There's argument to that, and the reason I pause is because let's look, for example, at Mutual of Omaha. Okay, Mutual of Omaha has been in the business since mid '80s, and they're still selling product today. When they look at a block of business, let's just say New Hampshire policies that were sold in 2008 and 2009, and they decide, hey, we need 5% rate increase. Anytime they do a rate increase, there's negative publicity. And if you Google long-term care rate increase, you're going to see pages and pages and pages. Blogs of people, they're raising my premium. It's a negative social impact when a carrier does that. Well, Mutual of Omaha can say, this is only 5% in New Hampshire. How about we just raise the pricing on our new policies to help inject new capital into that risk pool? And that's going to help offset some of this marginal or smaller, pricing mistakes from the past. Well, if they're no longer selling policies, they don't have that luxury. How much of an impact that actually has on past rate increases? I think it's pretty marginal. We're seeing Genworth. Genworth doesn't sell new product anymore, and they're seeing pretty significant rate increases, 60%, 70%, 80%. But even after those, it's still 10% of what a new policy of similar would cost. So I wouldn't be too concerned about that. The piggyback to that is also, what if my carrier goes out of business? And we haven't really seen that in my lifetime yet. There is one in receivership, which is Penn Treaty, but they've paid every claim in accordance with the contract as opposed to going to Guarantee Association. But Guarantee Association on a long-term care contract is $300,000 per contract. So if it's one contract or one policy number that covers two people, it's 300,000 as maximum benefits. If each person has their own policy number, it's 300,000 each person. Again, something we haven't really seen in our lifetime at this point.
Not horrible. It's still a pretty big pool of money.
Right.
All right. If my parent is showing memory problems but has not been diagnosed with dementia, do I need to declare that on the insurance? And if so, will I be declined?
No, so my suggestion, if we're walking through an application, is read the question. The question's going to say something like, has a parent or grandparent been diagnosed with any of the following? Well, if they're not diagnosed with dementia, they're not diagnosed with Alzheimer's, I personally would answer that question no, even though I know that there's some things going on. I think you're perfectly okay in answering that question no. Now, the moment that they say, "Hey, we just diagnosed mom with Alzheimer's," yes, we need to answer that question. Yes.
Okay. And then the last question I think you answered, but we'll ask it anyway. Since hybrid policies do not increase the premiums and traditional ones can, would that impact your thoughts on hybrid policies?
It really doesn't. And the article that we wrote on this, we walked through some pretty significant examples. The main thing is a hybrid contract is taking a lot of premium from an individual upfront, and they're spreading it over a mortality risk that we all know every one of us is going to die. It's just a guarantee. But what happens is you're buying life insurance when you don't need life insurance in order to be able to have that long-term care component attached to it. It is extremely expensive. We will have advisors that come to me and say, my client's been working with this other insurance person. He wants them to buy Lincoln MoneyGuard. What do you think about it? And we even have templates and tools that I'll put all the data in from that with traditional long-term care policy. They're going to walk away and say, we're way better off just paying the premium on a traditional long-term care policy and leaving our money working somewhere else. The issue with those contracts is they're just so inefficient. And typically what we're seeing now for a couple, just in a 20 funded product in today's world, you're looking 20 to $40,000 a year in premium. So when in that $20,000 premium is without inflation, a traditional long-term care product in that range is probably about $4,000 a year in premium because of how much of that impact is. So if I would rather give 4,000 a year, that is going to go up. We know it's going to. Even if it gets to 8,000 a year, I'm going to pay less in premium by 90 years old than I would in this life insurance product. And by leaving that asset on the side to continue doing what it's doing, you're eliminating the loss of that opportunity cost. And I think that unfortunately that's a luxury that only kind of people, of means are able to consider those hybrid contracts. But when you do so and you compare it to traditional coverage, you're almost always going to find significantly more efficiency in that traditional product.
Yeah, it's a smokescreen to give people peace of mind, but they're not looking at the opportunity cost of of the, getting the money outside of their corpus.
Well, and I'll tell you, I mean, Jonathan, the way that they, when wholesalers call me and say, Bob, you should be selling our product, the commissions on those are three times what we get paid on traditional. So and that's why the industry is, you don't find a lot of people like me that really support the traditional product because there's a lot of questions. It's hard to obtain. I've got to tell you things like the premium's going to go up, and if you die, you don't get anything back. All the things that don't sound really attractive is to me the better way to go. It's so much easier for me to say, hey, the premium will never go up. You've got all of this, and the insurance company pays me three times what they do on the traditional product. The industry is really gravitating to those, but it's because it's what benefits the insurance company.
Yeah. Well, you're an honest broker, and there's not many of you around. Last question. This is I guess I don't know if you'll be able to answer this, but they're asking what is the commission paid on a $300,000 hybrid policy? Do you have a range there?
Yeah, absolutely. So the way that they pay commissions on hybrid contracts is it's based off what's called target premium. Target premium is how much they're accepting annually on the premium if it was divided over the life of the contract. It's more better to tell you how much we get paid based off premium because we don't get paid based off death benefit. But if let's say the contract premium was a single premium of 100,000, target on that's probably about $11,000, $13,000. Your compensation percentage is based off your business volume. At my volume, we'd be the top of that. It'd be about 110%. So about $12,000 what they pay me to write a contract like that. To give you an idea on traditional long-term care insurance, the street commission rate is 50% of annual premium. So if that $11,000 contract we look at, street commission is 50% of that, so about 5,000. The more business volume that you do, the more that they pay you. I'm at the top brokerage contract with every carrier, and we're at 75%. So it's
What,
either
what does street commission mean?
I'm a day one broker. I
Okay,
walked in and I'm talking to my mom and I'm selling her a policy. I mean, to give you an idea, I'm one of the top producers in the country when it comes to long-term care coverage, and they pay people that do more business more money. That's all it is.
gotcha.
So someone that has that one, and think about it in the mutual fund world, right? The person that, has larger transactions typically, is getting a larger percentage as well.
All right, so that's all the questions we have. All 16 of them were answered. Um, Appreciate the time you took today. This was a lot of ground that we covered, and we learned a lot, and appreciate having you on. Like I said, this is going to be recorded. We'll be putting it on our website and sending out the link to all attendees along with Bob's slides. And Bob, thank you so much.
I appreciate the opportunity. I wish everyone a wonderful day.
All right, take
Bye.
care.